Welcome to today's edition of the Statler Financial Radio Show. Your financial security is our business. Have a question for the team? Call today, 863-877-1188. That's 863-877-1188.
Welcome to the Statler Financial Radio Show. I'm your host, Stephanie Griffin, and it's no secret retirement planning can be pretty overwhelming at times. Even when people who've done everything right can suddenly have more questions than answers. Right now, though, more retirees than ever are sitting down with financial advisor Philip Statler for the very first time. If you have retirement questions, too, you are in luck because Philip, he is founder and president of Statler Financial Services. Philip is here with us today. And before we get started, though, and say our hellos to Philip, there's a special offer for listeners of our show today. If you have $500,000 or more saved for retirement, Statler Financial is offering their free core retirement design for listeners who want clear answers, who want to know what's going on with their retirement questions. There's no cost, no obligation. Just call 863-877-1188. That's 863-877-1188. Hello, Philip. How have you been?
Hey, Stephanie, doing well. Just come off of about a 3-week road trip, just taking the camper and doing a little loop and visiting some old friends we haven't seen in a while. So it's good to be back in the office and back at it again as summer's really kind of closing out for folks. I know school's back in session here and things like that, but I mean, you know, summer's really not over till what? Labor Day, right?
Right. That's what they say. Yeah, I think you're right. And I know, yeah, my son went off to college. We moved him in his dorm room on Friday. So we're getting ready for fall, getting geared up for fall. We're going to start today with 5 common questions, Philip. 5 common questions retirees ask financial advisors like yourself. So are you ready to go?
Sure, man. Let's see what they are.
Okay. Question number 1. Should I move my retirement account out of my old employer's plan? I think I know the answer to this one, but you go ahead.
And that's a good question because people don't always realize they have options, right?
Right.
And so first, let me just say, not always. Sometimes it's okay to leave it there. It really depends on what investment options do you have available. What are the plan features? How old are you? Right? Because if you are younger and retired, then there are some options to take money out of your 401k on a regular basis and not have to pay that 10% penalty. There's a 55 rule. So you don't get that with an IRA. So there are some advantages sometimes, but it really just depends. You need to run the numbers, see the options, and weigh everything that's out there before you make that decision. Second, a lot of people will roll their planned money into an IRA. And typically, they're going to do that for a couple of reasons. One, it opens up a lot wider range of investment choices. You've got all kinds of options once you do that. You're not limited to just what options are available within that 401k plan. So that is an option, and a lot of people do that. You want to, I will just say this, if you're going to roll it to an IRA, you want to do what's called a direct rollover, though.
Okay. Because
what that does is it keeps you from having to pay tax on that money. 401ks are required to withhold about 20% for taxes if you take money out of your 401k.
That's a lot.
Yeah, it is. And so even if you plan on putting in an IRA, you don't want to get that 20% haircut, right? You want it all there. So do a direct rollover, and then that way you will have more control over the tax implications as well. And then just, a good financial advisor is going to help walk you through all those options and kind of walk you step by step on how that process works.
Very good. Yeah, it's nice to know what's going on with the process for sure. So up next, how much can I actually pull from my accounts each year?
Sometimes, Stephanie, that's a moving target sometimes.
Uh-huh.
We get different numbers from different, quote, experts out there. The classic starting point, though, is about the 4% rule. I mean, that's been around for a while now, even though some people have modified and said, well, you really should take out less than that. That's a good starting point. Let's just put it that way.
Does it just depend on how much you have, maybe?
I don't know if it really depends on how much you have. It really depends more on other factors like how old you are, what does your financial situation look like, what's your health look like. Some of those things really play a bigger role in it.
Okay.
But that the rule is 4% a year, and then you kind of adjust it for inflation. But sometimes you can make a plan and put together a plan that makes sense that you can take more than that. It really and truly does depend on your situation. Everybody's different. They have different income sources. So that's one of those things that you really need to go through the planning process to determine what that looks like. I mean, we've run it where people have been able to take out more than 5%, but it's because their circumstances allowed that based on other factors that were involved, not just the account size and what they needed. So everybody's different, and you need to go through the process to determine what you can actually take out of yours safely.
Very good. Okay. Well, you are listening to the Statler Financial Radio Show, talking about 5 common questions retirees ask financial advisors like Philip Statler. So let's go on to the next question. When should I start taking my Social Security checks?
Stephanie, you really got some loaded questions here.
Got to keep you on your toes, Philip.
So here's the deal when it comes to Social Security, right? Everybody's going to be different, but I can tell you this. Claiming too early permanently locks in a smaller monthly benefit. And I have a lot of folks that think, I want to take it at 62, and they got all kinds of reasons. But the one reason that they don't really have is that there's other options out there that may make more sense. So claiming it really early locks you in to a small benefit. It locks your spouse into a smaller benefit. That's not what you want to do typically. There are times that makes sense, right? Health, other issues that come into play. But here's the deal. Waiting past your full retirement age, which for most of us now is 67, right? If you wait past that, every year you wait longer, you get an 8% raise, guaranteed. So that's like you earned 8% more for your lifetime after that. That's a huge deal.
Yeah.
So if you wait till 70, the average person is going to get 24% more money than they would have at age 67. Now I know there's people that can't wait that long, and I get it, but there's also people I know that are continuing to work, and they don't really need the money. They just feel like they need to take it. So look, if you're still working, I wouldn't take Social Security yet. I understand there's reasons why, but you need to walk through that process to determine what's best for you, what's best for your spouse. For many people, delaying is the best guaranteed return they can get, that 8%. So again, it's not right for everyone, and you definitely need to run the numbers. So listen, if you've saved, $500, $1 million or more for, when it comes to your retirement, you need to get real personalized answers to these questions and others. Our complimentary core retirement design is built to show you exactly what you can spend, how long it's going to last, and where we're going to pull from first. There's no cost, no obligation. Call us here at Statler Financial, 863-877-1188. That's 863-877-1188.
All right, some great information, Philip. Let's move on to our next question. You are listening to the Statler Financial Radio Show. The next question, should I do a Roth conversion?
That's a good question. And again, it depends, right? It depends on your circumstances. Let me explain. A Roth conversion moves money from your pre-taxed account in your IRA to a Roth IRA. And that Roth IRA grows income tax free, meaning you don't have to pay income tax when you start pulling money out of that Roth IRA. Now, the catch is when you put that money into the Roth IRA, when you convert it from the traditional IRA to the Roth, Uncle Sam wants you to pay tax on that money. And so, there's different strategies to convert just enough to stay in your lowest tax bracket. That's really the key, Stephanie,
right?
Is we don't want to jump tax brackets. So if you're in the 12% tax bracket and you could convert $5,000 or $10,000 from your traditional IRA to your Roth and still stay in that 12% tax bracket, then you should do that. You should take advantage of that. If you're in the 22% tax bracket and you could take $25,000 out and still stay in the 22% tax bracket, then you want to do that. So there's things like that you need to look at and run the numbers to see what makes best for you. If you do it right, it helps reduce your tax burdens, not just for you, but for your entire family, your beneficiaries, for decades to come. And again, it's not right for everybody, and it's not right for every situation. You really have to run the numbers.
Okay. The question many people have when it comes to their retirement, will my savings last? Now, how do you help people find that out? That's a big question.
Well, you start by looking at everything. What accounts do you have? What investments do you have? What real estate do you have? All of those things. And then we want to look at how much are we spending? And we need to match our income against what we're really spending in true. And so we really just lay that out in our planning process. And that's part of the income plan, right? The income plan really determines how much can I pull out safely and still make sure that I don't outlive my money. Again, folks, a lot of these things we talk about today, it's a process we need to walk through. And if you don't have answers to some of the questions specifically for you that we talked about today, you're not alone. These aren't simple questions. The answers are different for every single person out there, but they are answerable. They can be put in a simplified way that you can understand what's happening in your retirement. And getting them right can change your retirement completely. Again, if you have $500 to $1 million saved for retirement, give us a call here at Statler Financial to schedule your free personalized core retirement design, where we'll look at where you are now, what the risk looks like in your current portfolio, what does taxes look like, not just today, but for the rest of your life. And we'll look at income planning to make sure you're on the right path to the retirement you always dreamed of. Give us a call right now at 863-877-1188. That's 863-877-1188.
Some great information. Thank you so much, Philip. And the Statler Financial Radio Show will be right back. Turn your plans of yesterday into yes today. Don't wait another day for a routine checkup of your retirement plans. Call Statler Financial Services, 863-285-3815. That's 863-285-3815.
Many people don't plan for long-term care until they have to. But long-term care isn't just nursing homes. It can include in-home care, assisted living, or ongoing support over time, and those costs often aren't covered by Medicare. That's why Statler Financial Services helps clients plan ahead, looking at how long-term care fits into a broader retirement strategy. Planning ahead is not about expecting the worst. It's about understanding your options. Call Philip Statler at Statler Financial Services today at 863-877-1188. Philip and his team offer guidance to clarify your choices and cost before you need to act, no matter what life brings. Now is the time to learn more. Call Statler Financial at 863-877-1188, or you can text VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Time to retire right. This is the Statler Financial Radio Show.
Welcome back to the Statler Financial Radio Show with founder and president Philip Statler. I'm Stephanie Griffin. Thank you so much for listening today. Market volatility isn't a question of if, but when. But here's the truth. With the right preparation, market corrections don't have to derail your financial future. Philip, let's get started with fundamentals. Why should every investor, regardless of their age or portfolio size, have a plan in place for market volatility before it happens?
Well, I think a couple of things. One is, I think you said it just a minute ago, it's not, if it happens, it's when it happens, because we know historically it's going to happen. We just don't know when. So a couple of things that we need to make sure that we are ready when it does happen. Emotional decisions during downturns can be wealth destroyers. We saw that in 2008, where people bailed. When we call it capitulation. That's when everybody starts bailing out of the market instead of holding tight because they just can't stomach it anymore. So emotionally, you need to make sure that you've got that tied down. How much are you willing to hang in there? Corrections happen on a regular basis. Now, correction is when the market drops by 10% or more, but less than 20%. 20% or more, we start to call that a bear market. It's more than a correction. So they're going to happen on a regular basis. And so having a plan helps eliminate those panic-driven mistakes. And that's where having that retirement income plan in place, knowing where your income is going to come from, and making sure that it is a little bit more protected than the rest of your accounts goes a long way to helping you weather those storms. So preparation allows you to see opportunities too, not just the threats that come when the market declines.
And if you'd like to talk to Philip about your portfolio, you can do that by calling 863-877-1188. That's 863-877-1188. And yeah, we've seen it happen. We've all seen it happen. Investors who seem to have everything figured out suddenly make devastating mistakes when markets get rocky. So what are some of the most common and costly errors you see people make when they haven't properly prepared for market volatility?
Selling at the bottom to, quote, stop the bleeding. At that point, if you're at the bottom, you might as well ride it out. A caveat, right? As long as you've got a well-diversified portfolio. Now, if you're in all, penny stocks or something that's very, very risky, well, that's a different story. I'm talking about people that have a well-rounded, a well-balanced portfolio. Then those companies are good, solid companies. They're going to weather the storms like they have for years. So that's one. Moving everything to cash and missing the recovery. I got to tell you, I saw this last year. Stephanie, I had a client come in and say, look, I'm concerned about the election. I'm concerned about what's going to happen. I want to get out of the market. I want to go to cash.
Oh, wow.
I said, okay. So I let him think about it for a little while, and I gave him a couple other scenarios. Mm-hmm. Why don't we liquidate half and leave half invested? Well, he called me back and said, no, we talked about it. We just want to liquidate everything. Let's put it in money market. Let's see what happens with the election. And what happened? The election hit, markets bounce. And it's tough to get back in to the marketplace. So just an example of where we see it happen. Abandoning your diversification. Like I said earlier, all this relies on having diversification within your accounts. And that's a big deal. And then letting fear override your long-term strategy. The younger you are, the easier this is because you got a lot of time left. The closer you get to retirement, that's why we need to start making adjustments to what our accounts look like before we get to retirement. I would say 5 years before retirement, we need to start looking at those accounts and making adjustments so that we don't have too much risk in there for retirement time.
Well, some investors think they can actually wait until they see trouble coming and then make adjustments. I don't know about you, Philip, but I don't know how to time the market. And I know that's pretty difficult. So what makes it so challenging to predict when volatility will strike or when stocks will go higher? And why is waiting until it happens such a risky strategy?
Here's the deal. Nobody knows, what the market's an emotional machine. A lot of times it's emotion that drives the market. Yes, the traders out there, the people that do this for a living, they're looking at, either charts or technical analysis or fundamental analysis or all those things. But you can throw those things out the window when emotions hit. And so we don't know when the next thing's going to happen. Right. And just because the markets are down doesn't mean the stocks in your portfolio are down. You may have stocks that are, counterproductive. They may go the other direction. So you just don't know. Just because the market's down doesn't mean your account's going down. I see that all the time. And so you just need that to make sure it comes down to those couple things, Stephanie, making sure that the risk in your portfolio overall matches up with the risk you can handle. And we saw this back in 2008, where people thought they were a moderate investor. Unfortunately, a moderate portfolio back then lost 15 to 20%. That was way more than the moderate investor thought they could lose. And so they figured out real quick they weren't really moderate investors. The problem is they found out too late. We want to find out ahead of time what kind of investor you are so that we can pick the right kind of portfolio. And that helps with that whole process.
You are listening to the Statler Financial Radio Show. You can go to his website, statlerfinancial.com, find out more about the services that they have. And you can also give them a call, 863-877-1188. Sit down with Philip, talk to him, have that free consultation. 863-877-1188. Now, Philip, you've helped a lot of clients prepare for and navigate through various market cycles. For someone watching who's thinking, I know I should prepare, but I don't know where to start, how do you help people build a comprehensive volatility preparation plan? That's a mouthful.
Well, that is a mouthful, and but it's a good point to make. And I guess really, Stephanie, it starts with understanding the amount of risk you can handle. And we've got a couple tools that we use here at Statler Financial to help us ascertain what that number is for you on a scale of 1 to 100. What does that look like for you? And so we plug that into our system and build our portfolios around that. And we can show you, look, based on your risk number, if we had another 2008, here's what it would look like for your portfolio versus what your current portfolio looks like. If another 2008 happens, here's what your current portfolio would look like. So sometimes that helps people understand what the differences are between different portfolios by, when we run those big booming situations, what could happen. And so that really helps them get a better picture of risk and how it affects their portfolio.
Since every investor has unique circumstances, risk tolerances, and goals, can you walk us through the kind of personalized volatility assessment you can provide for clients?
Absolutely. And that's really our core retirement design, Stephanie, is that process where we'll sit down with folks and make sure and actually run a risk analysis on their current portfolio to see, okay, what is the risk in that portfolio on a scale of 1 to 100? We run you through an analysis to determine what your risk score should be. And then we compare the two. If your risk number is a 52 and your current portfolio is at 75, well, there's a big mismatch there. And so we need to make sure that we get on the same page, that our portfolio and our risk tolerance are on the same page. And that's really what we strive to do here at Statler Financial.
Philip, can you walk us through the process at Statler Financial Services and tell us a little bit more about that?
Absolutely, Stephanie. So we start with a no obligation, a 30-minute phone call. That 30-minute phone call is really where you can ask us questions. We'll ask you questions. We want to see where you are and what your ultimate goals are. And if you're on the right path to get there, God bless you. We're going to let you know that, or we're going to encourage you to do a couple things and set you on your way. If I see a place where I think I can help you, I'm going to let you know that. Hey, look, I think that we could help here, or I think you're off track there. And then we would sit down together in the office and go over, or by Zoom. I can do Zoom meetings too. And we'll go over where you are and collect the data that we need, statements, tax returns, all those things to put together a financial plan for you. And by doing that, then our next step really is we get to work and we run the risk analysis on your current portfolios. We also then get what your risk assessment looks like. From there, we look at the fees and expenses you're paying inside of there. We move on to taxes. We prepare a tax plan and see, if there's any opportunity for you to be saving in the area of taxation. And when I say saving, I don't mean saving just for today, but I want to save you a lot of money over your retirement lifetime. And so sometimes, Stephanie, that means we pay a little bit more tax today and tomorrow in order to live tax-free the rest of our retirement. So that's the second leg of our planning process. The third leg is putting together that income plan, showing you where the income's going to come from, how we're going to get the income we need. And then the big number is, how much income do you have to spend? We'll come up with all of those things in the third leg of our core retirement design. So when you're done, you have a risk analysis, a tax analysis, and an income plan all put together for you, ready to go. And so that's really our core retirement design. Again, we want to help people have the retirement they always dreamed of. It's a simple phone call to get started. Give us a call at 863-877-1188. That's 863-877-1188 to schedule your 30-minute phone call. Or you can go to my website at statlerfinancial.com. There's a link there that you can click and schedule a time as well. I look forward to speaking to you soon.
And we will be right back, and we're going to be revealing specific strategies for building your volatility defense system and the critical mistakes that could leave you vulnerable when markets turn turbulent. The Statler Financial Radio Show will be right back.
Needing a second opinion on your retirement plan, or to see if you're paying more than your fair share to Uncle Sam? Schedule your complimentary visit today. Text VISIT to 863-877-1188. That's VISIT to 863-877-1188.
The market goes up, it goes down, but retirement keeps going. And when you're close to retirement, those swings can feel very different. At Statler Financial Services, our planning focuses on helping plans stay aligned through market movement, so short-term volatility doesn't disrupt your long-term plans. It's about balance, income planning, and staying disciplined through changing markets. Call or text VISIT to 863-877-1188 now for your free risk analysis from Philip Statler at Statler Financial Services. If you're nearing retirement or already there, now's the time to review your strategy. Take the first step. Get your questions answered before the next market volatility takes a chunk out of your portfolio. Call or text VISIT to 863-877-1188. That's VISIT to 863-877-1188. Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back. It's the Statler Financial Radio Show. Let's get into the specific strategies that can help protect your portfolio and your sense of reassurance Philip, what does a well-structured volatility defense system actually look like? It sounds so stealth or something, I don't know. And how can it help protect investors when markets become turbulent?
Well, I think one is, your core holdings need to kind of have some stability. So you've got a core portfolio that's going to kind of be the bread and butter that's going to be there, all the time. And then we have growth positions to help combat inflation. The one thing I know is as I talk to people all the time is, I don't want to be in the stock market. I'm going to tell you something. When I have 90-year-olds that we have at least 10% of their portfolio is in the market. Why? Because it helps combat inflation. And we know inflation has been pretty bad here the last few years. And so this is one area that can help offset some of the inflation. And then, having some protected income generation strategies. There are, dividend portfolios that you can put together that would have some specific, allow you to throw off some specific amount of income. There are annuities out there that will give you an income stream for the rest of your life. And those can be beneficial. That way you don't have to worry about the ups and downs of the market. If they go down, it doesn't matter. Your income's not going to be affected. And then the last thing I think that people, I think they know they need to do it, but they want to retire early, so they don't care. And that is, folks, you need to optimize your Social Security benefits. You really need to do the math to figure out when is the best time for you to take Social Security. I understand if health is an issue and you need to retire at 62, but there's a lot of folks out there retiring at 62 or taking their Social Security at 62 and still working, that it is not a good idea to do that. And we need to look at why it's not a good idea. And we need to look at how can we do better and protect our spouse. And there's a lot of things that go into optimizing Social Security. It's not just the dollar amount that's there when you start drawing. And those are the things that we look at and talk about when we start talking about optimizing your Social Security benefits.
Now, there is a fascinating psychological component to market volatility. How can investors prepare themselves mentally and emotionally for the inevitable stress that comes along with the market downturns?
It's hard to really, kind of get that psychological component put together, because so many people live in fear. And so when the market starts to drop, they fear creeps in and starts to really take effect, right? So I think if we look at a couple of things, one is understanding your true risk tolerance before the crisis hits. Like I said earlier, people in 2008 found out they were not moderate investors too late after their accounts were already down 15, 20%. And so understanding what your true risk tolerance is before a crisis hits is a huge deal. It really, truly affects how you should be investing your money. Other thing is maintain historical perspective on the market recoveries. I mean, if you look back, I can go back to 2000, right? One of the first major bear market I went through as an advisor. And what we have seen both in 2000 and 2008, if you had a well-balanced portfolio, well-diversified portfolio, it basically took you 4 to 6 years to get back to even. And so you need to have that perspective on market recoveries. Now, we've had some, right? The COVID bear market was a flash in the pan. It was down 30%. In 6 weeks, we were back to where we were. So it does happen that way. Corrections, we have a 20%, 10% correction, and, within a couple weeks, we can be back up. So markets recover. And then we need to have a written plan, because that will help us reduce the emotional decision-making that we're trying to do. Having that written plan that we can go back and look at is a huge deal. And then bucket planning, putting your different accounts in buckets. This is the bucket I'm going to draw from. from day one retirement until day 10 of retirement. Then I'm going to go to this bucket. So having the bucket approach can really help us plan out how we're going to use the income, and lets us put part of it, that last bucket we're not going to touch. If it has ups and downs, it doesn't really matter, because we don't plan on using that bucket anyway, except for emergencies and to leave to our beneficiaries. So that's part of the planning process there.
You know what, you said bucket planning. I thought we were adding to our bucket list. That meant. All right, let's address something that keeps many investors up at night: the fear that this time the market won't recover the way it has historically. So, Philip, how can investors balance learning from history with preparing for unprecedented events?
Well, I think that one thing, we diversify beyond traditional assets. If we look at some of the other models out there, when it comes to endowments and those type of things, how do they invest their money? They use some non-traditional assets to help when the market gets a little rough. Stress testing. I mentioned this earlier. Stress testing for various scenarios, taking your current portfolio and looking at what would have happened in 2008 if I had this current portfolio right now. Gives you some sense of okay, I can handle that, or no, I can't. We need to make changes. A big thing is this, Stephanie, you need to focus on what you can control: tax strategies, Social Security optimizations, diversification, and then maintain flexibility to adapt. That's huge. We got to be flexible to be able to make changes. All of this wrapped up is our core retirement design. I'd love to sit down with you, talk to you about it, see if we can help you develop the retirement plan that's going to give you that retirement you always dreamed of. Give me a call at 863-877-1188, 863-877-1188.
And you can also text VISIT to that same number and contact Philip at Statler Financial Services, 863-877-1188, and get in for your complimentary visit. Now, we've covered a lot of ground today about preparing for market volatility. For listeners who are realizing they may not be as prepared as they should be, what kind of comprehensive portfolio review process do you use to address volatility vulnerabilities?
That's a lot of these.
There's a lot.
Yes. Again, the first component of our core retirement design is really identifying and measuring the risk you have in your current portfolio. And that's going to give us, based on that number, we will know how volatile your portfolio could be. And so from there, we have kind of that view of, here's what it looks like. Here's what it would look like in 2008. What do we want to do about it? Are you comfortable here? If not, here's some suggested changes we might want to make to make sure that we're okay on that front. It's planning. If you have a plan in place and the markets are going to go up and down, or maybe they go down and up, but they're going to be volatile. And if you're ready for that and you're mentally prepared for it, then you can weather those storms. And having that plan in place is a big part of it, Stephanie.
And, every investor situation is unique. We talk about that all the time on this show. So how can you create a customized volatility preparation strategies that align with each client's specific circumstances?
You're right. Everybody comes in with a different set of assets. They all have different goals. They have different concerns about what volatility looks like in their life. And so it is, again, and I feel like a broken record sometimes. It's putting together that plan, having that plan in place that will, really allow you to invest properly, understanding the amount of risk that you need to have in your portfolio to grow, but yet the amount of risk you need to be comfortable with. And I think that's really the bottom line, is getting folks comfortable with the risk. And some people honestly never get comfortable with the risk. I can't tell you. I've got several clients that will say, I don't like the market. I know you do. I don't really necessarily like the market, but it's a tool that we need to use. And they trust that we are doing what's in their best interests, which is why we're meeting with them, why we're making changes to portfolios and making sure that they're in the best possible position they can be in. And that's all part of the process. You have to meet with people. You have to assess their fears, walk them through it so they understand where they are, and let them ask questions. And the questions they ask are huge, and being able to educate them on why it's important, it is a big part of what we do. And it's part of what we like to do, is we want our clients educated about why they are in what they're in, why we're using these tools in these certain ways to get them to where they need to be. And that's what it's all about, helping people be comfortable in retirement. I'd love to help you. Give us a call at 863-877-1188. That's 863-877-1188.
And that's what I love about you at Statler Financial, Philip. You let people go in, you talk to them, you don't talk at them, you help them understand, and if they have questions, you are happy to answer them. So please give him a call for a sit-down, a free consultation, 863-877-1188. And the Statler Financial Radio Show will be right back.
The market goes up, it goes down, but retirement keeps going. And when you're close to retirement, those swings can feel very different. At Statler Financial Services, our planning focuses on helping plans stay aligned through market movement, so short-term volatility doesn't disrupt your long-term plans. It's about balance, income planning, and staying disciplined through changing markets. Call or text visit to 863-877-1188 now for your free risk analysis from Philip Statler at Statler Financial Services. If you're nearing retirement or already there, now's the time to review your strategy. Take the first step. Get your questions answered before the next market volatility takes a chunk out of your portfolio. Call or text visit to 863-877-1188. That's visit to 863-877-1188. Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back. It's the Statler Financial Radio Show with founder and president Philip Statler. I'm Stephanie Griffin, and each week we get questions from you, the listener, and we use them in our mailbag segments. All kinds of questions today, Philip. Okay, are you ready for the first question?
I think so. Give it to me.
Okay. All right. Mary from Lake Placid asked, my husband and I will retire around the same time, and we are considering moving abroad. How might that impact our savings and pensions?
Man, that is a question I've not had to deal with much, but I can shed a little light there. It should not have any impact on your pensions. I think a lot of times you do need to make sure you have a U.S. bank, which means you have to have a U.S. address for those type of things. But it shouldn't impact any of those things. You may have to use different types of investment accounts if you're living abroad. The typical accounts that we use Schwab as our custodian. And so there's certain things that we don't have access to if you're not a resident of the United States. So it could be a little bit harder in that respect. But I know that sometimes it's great to live abroad, right? Sometimes it's cheaper to live abroad than it is here in the United States. So I probably haven't answered your question appropriately, but it is one of those things that is not something we deal with very often. But you definitely would need to to dive in and do some research there to figure out what other things might be impediments to making that work for you.
And we can go visit them, right? We can go
That's right. Yeah,
with them and visit abroad. All right. You are listening to the Statler Financial Show. Jeff from Sebring wants to know, I know that the government tends to spend a lot of money, but I'm not sure.
Really?
I know. I don't know what he's talking about. Jeez, but I'm not sure how it impacts me. How can I educate myself on ways to help protect my wealth? It's a good question.
It is. How do we know it impacts you? I'm going to tell you where it impacts you is in taxes, right? Because the government's got to get their money they're spending from somebody, and it's you and me that they get it from. So one of the things that you can do is start to position yourself into Roth IRAs instead of traditional IRAs. So there's a thing called Roth conversion, which is a taxable event. It could have several different types of consequences, not just tax, but Medicare related as well. So you need to have full disclosure before you do any of these things, and make sure you run the numbers, have somebody that's qualified run the numbers so that you can look at all these different thresholds that you can't go over before it starts to cost you money. So Roth conversions are a big deal. And if you can stay in the same tax bracket you're currently in and do Roth conversions, I would do those all day long, because tax rates, we know we've got until I think probably 2029, 2030 before we don't know what's going to happen with tax rates, right? We know that we've got them low for now. So while they're low, we need to go and seek about Roth conversions, do the planning, look at it and see if it's right for you and if it's going to benefit you from the long term.
All right. Mark from Avon Park wants to know, I've worked hard all my life. How can I help ensure my retirement years are as fulfilling and enjoyable as possible without having to worry about finances? That is the last thing you want to do when you retire, is worry about your money. You want to be able to go out and enjoy it, don't you?
You do. You'd be surprised, though. I get some guys in here that they like spending the first couple hours of their day in the market trading. It's crazy. I mean, if I retired, I'd want to put all that behind me. But it is. So, having a plan, basically, Mark, that's the bottom line. We need to have a plan in place. And if you have a plan in place, that's going to help you get you to where you need to be. That plan gives you that track to run on. And then, yes, you still have to look at your finances. You still have to be cognizant of what's happening around you and how it's affecting your current accounts. But I think it's very doable at that point, as long as you have a plan in place. And then you review that plan with your advisor at least once a year to make sure you're on track to keep going the way you're going.
And if you'd like to talk to Philip, you can do that by calling that number 863-877-1188. That number again is 863-877-1188. You can text the word visit to that same number, get in for your free consultation, and talk to Philip at Statler Financial Services. Alex, he writes a pretty big question. He's from Cypress Gardens. My dad worked at the same job for 30 years before he retired with a pension, and it just seems like he's never had to worry much about money. I've worked for 3 different companies, but I've always made sure to contribute to the company 401k with each position. I'm realizing that I should do something with those different accounts. There's a good amount of each of those accounts, but I don't know how to consolidate the money or if that would even be the best thing to do for me. I'd sure love to enjoy retirement one day, just like my dad. What advice do you have for him, Philip?
So, here's the thing is that, folks like your dad who could retire with a pension, it just doesn't happen as much anymore, right? The private sector is kind of gone away from pensions and they developed the 401k. And so now you're going to be responsible for creating your own pension. And there's different ways that we can do that. But it's easy to consolidate these into an IRA. Your accounts that are out there, people usually don't leave them at the 401k. They usually end up rolling to an IRA so they have more control and better options for their investments from that standpoint. So how can you create some income? Well, I've said in different shows that there's a couple different ways you can create income. You could have a portfolio of dividend paying stocks, but it's still, you're relying on those companies to pay that dividend every single quarter. And it can, cash flow may not always be even. Because of that, they pay quarterly. Another area that you may want to look at is annuities. Now, annuities aren't for everybody, but they are a contract between you and an insurance company that helps provide income. They will provide a lifetime of income for you. And if you do them right, you can do a joint so that it's going to provide that same income as long as either you or your spouse are alive. So there's some things you can do to help create your own pension. And those are some areas that we do look at within our core retirement design, where we're kind of designing the income planning part of it. We can look at some of those options to see if they make sense for folks. Sometimes they do, sometimes they don't. It just doesn't add up and doesn't make it worth the effort to do those. So, but we look at those as an option to see if they may work for you. So that's just an area that we look at. Again, our core retirement design, as we kind of close out the show today, is really that. We look at the risk. And in today's show, we've talked a lot about risk. Taxes, folks, taxes are a risk to your retirement income because you have a partner, Uncle Sam. Every time you take money out of that retirement account, he's got his hand there. He wants his share. The problem is you don't know what his share is going to be because you don't know what the tax rate is 15 years from now. So we want to get everything as tax-free as possible. And then having that income plan really just gives you a track to run on, gives you a plan in place that you can adjust, but it gives you something to look at every year and see, am I on track? Am I getting to where I need to be? And that way, your money's going to last as long as you need it to. Those are the areas you need to look at. That's why I developed the core retirement design. I'd love to talk to you about it. See if you are on the right track to the retirement you always dreamed of. It's a simple phone call, 863-877-1188. That's 863-877-1188. Give me a call and let's chat, see what we can do to make sure you're on the track you need to be on.
Philip, it was so great to talk to you again this week.
Hey, good to talk to you, Stephanie. You have a great one, and we will talk to you next week.
Sounds good. Talk to you next week on the Statler Financial Radio Show.
Advisory services offered through Second Half Financial Partners, LLC, a SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. This radio show is a paid placement.